We are going to talk about fair value gaps and inverse fair value gaps today. That is going to be the discussion because you have probably been using them wrong your entire life. So what a fair value gap is, right? That's going to be the most important ICT concept that you can possibly use. It's literally attached to every single trade that I take, probably that you take too. So we're going to use them correctly. A fair value gap is a 3 candlestick pattern where the first candle and the third candle's wicks don't overlap. So you see this area here, same thing for a bearish range, this area here. You draw a square in between them. That is going to represent your fair value gap. So in a range, right, we're in a downtrend. We're looking for possible areas where price can retrace into to continue its trend lower. So we're looking, we do have one fair value gap that is right here. So we're going to highlight it again. And we're going to watch and see if price retraces into it and continue its trend downward. Very, very common for you looking for an entry is you look for a retracement to continue lower. Okay. For an inverse fair value gap, we have that same range. This time price is going to retrace into the fair value gap and close above. Once we get this candle closure above the fair value gap, it turns into an inverse fair value gap. So it's no longer a retracement, but it turns into a reversal in trend, and it's going to be much higher, like so. So once we understand fair value gaps and inverse fair value gaps, we can get a little more advanced, optimal trade entries, or OTE. The OTE of a fair value gap is going to be the middle point of the rectangle that we draw. TradingView actually has a tool when you go to the settings of the gap, you can turn on the middle line, and it'll look something like that. This is going to be the most optimal entry, right? The OTE of the fair value gap where you can make the most amount of money. So you see price retracing into this possible area. What you can go ahead and do is set your sell limit, okay? And we're going to get tagged in. Once we get tagged in, we're going to place our stop at a high. So either here or a little higher if you want a safer trade. And our take profit is going to go below wherever our drawn liquidity for the day is. And we're going to see that play out. For an inverse fair value gap, we have the same thing, right? The same trend. We're waiting for price to close above the fair value gap. That's when we're going to enter into our long position into a higher drawn liquidity. In this occasion, price closes way too far past our inversion. So if we were to enter way over here, right, it would ruin our risk to reward ratio because our entry is here and then look how far down our stop is going to be. And our take profit is going to be right here. So what we can do in this situation is we're going to add a buy limit order at the place of the inversion and we're going to wait. You're going to wait for price to retrace into your buy limit. It doesn't always retrace. Sometimes it'll just continue higher. And that's when you have to have good control, right? You don't want to chase price that's going up. You want to get the most optimal entry, which is going to be here. As you see, price retraces. We tag into our IFVG. We put our stop at the low, our take profit at the high, and we run all the way up and make some money, all right? That is how you use inverse fair value gaps properly. That is the most in-depth that I can go. It's not a hard concept to learn. It's pretty easy, but it's the most common one you're going to be using in all of your trading. The next video I'm going to make is probably going to be my entire model. So it uses SMT, inverse fair value gaps. We're going to talk about ranges, highs and lows, and draws and liquidity. So make sure you watched all my prior videos before going to the next one, because I'm giving you all the keys to pass your funded accounts.